Good evening, everyone. Welcome to the channel. Today I am going to talk about China OV's PPT interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. Unfortunately, the provided summary does not contain any information. However, I can provide a general template for an overview essay on the topic, list of businesses and services provided by a company. Here is a sample essay. The company offers a diverse range of businesses and services to cater to various needs of its customers. Some of the key areas include financial services, business consulting, marketing solutions. It support human resource management. These services are designed to provide comprehensive support to individuals, small businesses, and large corporations alike. The stock price of China Overseas Property Holdings Limited, 2669 HK, has increased by 17.56% over the past year, primarily driven by the company's solid financial performance and favorable analyst ratings. Key factors contributing to this rise include strong annual results for 2024, with a 7.5% increase in turnover, an 11.6% rise in operating profit, and a 12.5% increase in profit attributable to ordinary equity holders. Dividend announcements, including a final dividend of HKD 0.095 per share and an interim dividend of HKD 0.09 per share for the first half of 2025. Positive interim results for the first half of 2025, with an earnings per share (EPS) of CNY 0.23. These positive financial outcomes and dividend payouts have likely bolstered investor confidence in the company's individual performance, despite mixed signals from the broader Chinese property market. The primary drivers of revenue growth or decline are multifaceted and influenced by various market conditions. On the growth side, expansion into new businesses, winning major contracts, and overseas market expansion have contributed significantly to revenue increases. Additionally, strategic concentration on key regions and business sectors has yielded positive results. On the other hand, revenue decline is driven by factors such as a downturn in the residential real estate industry, severe market conditions, and price competition in existing markets. The shift towards becoming an integrated service operator for urban space has also led to a decline in certain value-added services. Furthermore, diversification efforts have resulted in mixed outcomes, with some segments experiencing significant decreases. Key statistics include revenue growth drivers, 31.8 million SQM of new orders secured, and RMB 257.8 million in total new contract sums. Revenue decline drivers, minus 62.9% decrease in car parking space trading business, and minus 11.6% decrease in value-added services to residents. Overall, the company's revenue growth is driven by strategic expansion and diversification efforts, while revenue decline is influenced by market conditions and shifts in service offerings. Net income and profit margins. A mixed picture. The company's net income saw a modest increase of 3.4% to RMB 1,029.7 million, driven by improved cost control measures and reduced selling and administrative expenses. However, the value-added services to residents subsegment experienced a decline in net income by 5.4%, attributed to decreased revenue. Profit margins also showed mixed results. The company's gross profit margin improved to 17%, while the value-added services to residents subsegment saw its gross profit margin decrease from 14.1% to 13.4%. On a positive note, this subsegment's gross profit margin increased to 35.2% in the current period. The reasons behind these changes are largely attributed to cost control measures and reduced expenses. However, the decline in net income from the value-added services to residents subsegment remains unexplained. The company's cash flow concerns. A review of the financial summary reveals that the company is struggling with its operating cash flow. The most direct information comes from page 35, which explicitly states that the company is generating negative operating cash flow. Furthermore, an increase in trade receivables from RMB 2,827,771 to RMB 3,517,297 on page 52 suggests a potential issue with managing cash flow effectively. This evidence collectively indicates that the company is not generating positive operating cash flow. The company's financial performance has shown some notable changes between 2024 and 2025. One significant change is a decrease in interest expenses by 26.5%. This reduction suggests that the company may have renegotiated its loan terms or reduced its borrowing costs. However, there is no direct information on net interest expenses, but it can be inferred that this figure also decreased due to lower interest paid for bank borrowings. On the other hand, cash flows used in financing activities increased by Rm 189 million, indicating a higher level of debt repayment or new borrowing. Unfortunately, there is no available data on changes to the company's overall debt level, making it difficult to determine if this increase in financing activity was due to an expansion of existing debt or new borrowing. The company's financial performance varied across different segments and regions in the recent period. Notably, property management services and engineering services showed significant growth, with an 8.3% increase in revenue and a 14% increase respectively. The Hong Kong and Macau regions also performed well due to increased acceptance of repair and maintenance engineering services. On the other hand, pre-delivery services, inspection services, and consulting services experienced substantial declines, with decreases of -19%, -46.3%, and -76.2% respectively. Home living service operations and commercial service operations, as well as total value-added services to residents, also underperformed, with decreases of -26.3% and -11.6%. The car parking spaces trading business was particularly affected, with a 62.9% drop in revenue and a 49.4% decline in profit. Management is optimistic about the company's future growth, driven by new economic opportunities in premium sectors. The medium to long-term goal is to implement a strategic methodology known as COPMPM, which will modernize property management practices. Overall, the outlook remains consistent, with no significant changes to the strategy. There were no notable acquisitions or divestitures reported in the financial summary. The company did not engage in any significant purchases or sales of assets, indicating a stable and unchanged business structure. The company has a history of paying dividends to its shareholders. In 2024, the company distributed RMB 156,680,000, and in 2025, it paid out RMB 185,708,000 related to 2024's earnings. In addition to dividend payments, the company has also engaged in share buybacks. Between 2024 and other years, a total of 11,482 shares were repurchased and canceled. There are no concerns regarding inventory buildup or supply chain disruption, as indicated in the financial summary on pages 14, 61, and 62. This suggests that current inventory levels and supply chains are operating within acceptable parameters. That concludes the financial summary for China OV's PPT. Feel free to comment below, and I will be happy to answer them when possible.